Welcome to Chapter 19 of Financial Accounting 2. This is taken from the Intermediate Accounting Volume 2 text, written by Kieso and all his associates as listed here. So Chapter 19 talks about pensions and other post-employment benefits. So Chapter 19 covers a variety of employee future benefits that are earned by active employees and expected to be provided to them when they are no longer in active service. So they earn it while they're serving as employees, and they will be paid to them after they're finished their active service. They're usually covered by the benefit policies of the organization, and the accounting for them is covered in the CPA Canada Handbook, Part 1, International Accounting Standard 19, and Part 2, ASPE Section 3462. So, accounting for pension costs is somewhat complicated because of the variety of social concepts and legal considerations, actuarial techniques, income tax regulations, varying business philosophies that affect the development and maintenance of pension plans. So this chapter relates these issues to the recommended accounting treatment for the costs associated with the pension plan. The majority of the chapter is devoted to discussing the complex accounting issues related to defined benefit plans, with benefits that vest or accumulate as the employee provides services. So the study objectives are listed here. We're going to talk about the importance of pensions from a business perspective. It's basically a way of taking care of your key stakeholders, your employees, in a situation where they're providing service now in exchange for our promise to take care of them in the future. And so that's rather important. We are going to talk about defined contribution benefit plan. This one's relatively straightforward. It's a lot like an RSP. And so basically you put in what you're required to contribute. So the company is required to contribute a certain amount, but they're not promising a certain kind of benefit, a certain amount of benefit. The other choice is a defined benefit pension plan, and so we'll talk about what that is as well. And this is a little more complicated because you're promising to take care of your employees to a certain level, usually of their previously existing best 5 years of salary or something like that. So you're actually promising an outcome as opposed to promising an input. Defined contribution means that you're promising a certain contribution. Defined benefit means a certain outcome, and your responsibility as a firm is to provide enough funding to ensure that those benefits will be reached. So we'll talk about a few of the key concepts, such as a benefit obligation. We'll talk about different ways of measuring this obligation. There are three theoretical methods, and one of those is considered preferable. We'll talk about preparing a continuity schedule and kind of a worksheet that we use to calculate the journal entries that we have to make from an accounting perspective. And then we'll talk about the transactions and events that change the assets which are being held for the benefit plan, and we'll calculate the balance of the assets, and we'll also talk about surplus or deficit and how to calculate and how to identify the transactions that we need to record for accounting purposes. We'll look a little bit at the components of pension expense, account for a defined benefit pension plan under both IFRS and ASPE, and we'll look at benefits which vest or accumulate other than pension plan benefits. So that would include like health benefits, health coverage, or other kinds of benefits. We'll discuss those in a second. We'll also talk about the types of information that's required to be presented and disclosed for such pension plans, and then we'll talk about differences between IFRS and ASPE accounting for them, and what changes are expected in the near future. So, benefit plans. There are three different kinds of benefit plans: pension, other post-retirement plans, such as healthcare and life insurance. One kind of benefit plans: post-employment benefit plans, such as severance benefits and long-term disability benefits, or compensated absences, such as parental leaves, unrestricted sabbatical leaves. Those sorts of things are benefits that we provide our employees. This chapter we're talking essentially about the pension plans. So a pension plan provides benefits to its to retirees for services which they provided during their employment. So if we're thinking about the idea of matching, those costs of paying the benefits in the future need to be matched against the revenue which we generated from using the employee's services in the current period. So the employer sponsors and contributes to a fund, and that fund is required to pay those future benefits. So the employer incurs the cost of the pension plan. So we have to look at the accounting for the employer. Also, the pension plan itself receives the contributions from the employer. It administers the assets, so it invests them in within whatever constraints are provided for the pension plan. It administers the investment of those assets, and then it makes payments out to the beneficiaries by liquidating those assets in a way that provides the benefits for the pension plan. And so accounting is required for the pension plan as well. Again, we're focusing essentially on the employer's accounting for the pension plan in this chapter. So if we were to draw a picture of what that looks like, the employer pays cash into the pension plan. Those are the contributions. The pension fund invests that cash contribution into fund assets, and then as necessary pays them out to the pension recipients as pension benefits. So we need to talk a little bit about the terminology which is required. So a pension plan, it's an arrangement where an employer provides benefits or payments to employees after they retire. And accounting for a pension plan, consideration must be given to accounting for the employer and accounting for the pension plan itself. And this chapter focuses on the employer's accounting. A pension plan is said to be funded when the employer sets funds aside for the future pension benefits by making payments to a funding agency, trustee, for example, that is responsible for accumulating the assets of the pension fund and for making the payments to the recipients as the benefits become due to them. Pension plans can be contributory or non-contributory. In a contributory plan, the employees bear part of the cost of the stated benefits, or they voluntarily make payments to increase the benefits. And if the plan is non-contributory, the employer bears the entire cost. Here at King's, our pension benefit plan is contributory, so we contribute a certain amount, and the employer, the King's University, matches those contributions. And there's no provision for additional payments in our case, but some pension plans allow employees to make additional payments to increase their benefits. So the employer has a portion which is similar to a non-contributory plan, and then the employee can top it up. And the benefit of doing that is that you are investing your assets in a large plan, so it can be properly diversified. It can be invested in larger investments, and it can earn a return along with all the other assets. Now, because the problems associated with pension plans involve very complicated actuarial calculations, actuaries are engaged to ensure the plan is appropriate for all of the employee groups covered, and they make predictions or actuarial assumptions about things like mortality rates, employee turnover, interest, earnings rates, investment returns on the pension fund, early retirement frequency, future salaries, other factors necessary to operate a pension plan. We used to say when I was a student at the University of Manitoba, which has a Department of Business and Actuarial Mathematics, we used to say that actuaries were people who wanted to be accountants but didn't have the personality. And so they tend to do very laborious calculations, and they're not spending a lot of time talking to other human beings but doing all of these financial calculations. So hence the idea of the personality. So anyway, accounting for defined benefit pension plans is highly reliant on the information and the measurements provided by these actuaries. So they're extremely important in this area of business accounting. Okay. My slides aren't moving forward here. Okay, so types of pension plans. There are two most common types: defined contribution or DC plans, defined benefit DB plans. Defined contribution plan, the employer agrees to contribute a certain sum each period based on a formula. The formula might consider factors such as the length of service, the age of the employees, the employer's profits, compensation levels, so salaries, wage levels. The accounting for a defined contribution plan is relatively straightforward, and the employer's responsibility is simply to make a contribution each year based on the formula established in the plan. So the amounts that are contributed are usually turned over to an independent third party or trustee who acts on behalf of the beneficiaries, who are the participating employees. The trustee assumes ownership of the pension assets and is responsible for their investment and distribution for the benefit of the pension employees. The trust is separate and distinct from the employer. The size of the pension benefit that the employee finally collects under the plan depends on several things, such as one, the amounts that have been contributed to the pension plan, the income that has been accumulated in the trust, the treatment, the forfeitures of any funds created by the termination of employees before retirement. So whatever happens to them if they don't last long enough with the company to actually receive the benefits, and the investment alternatives which are available on retirement. So your choices as to whether it's GIC sort of returns or you purchase from an insurance company, a registered annuity, something like that. Anyway, the benefits, the size of the pension benefit that you would get depends on a lot of things which are not required to be under the control of the employer. So in this way, it's a lot like an RSP. So you make the investment, and the amount that you can take out is dependent on how well your investment portfolio performs within that RSP. So the employer's annual cost is the amount it's obligated to contribute. If the contribution is made in full each year, then no pension asset or liability is reported on the statement of financial position. They've just made that payment for the benefit of their employees. So there's no asset or liability, there's just the expense of the payment that they make each year as part of compensation expenses. So defined contribution plans, the employer makes a contribution, and the cost of the contribution is the expense related to it. The accounting for defined pension, let's step back here. The employer is responsible for the contribution. They're not responsible for any additional outcome after that. They don't promise a certain benefit to the employees. So the money becomes the property of it's held by the trustee for the in trust for the pension beneficiaries. And so the trustee is responsible for making decisions with the plan assets. The employee assumes the economic risk because they could have a good return or they could have a poor return, and their pension benefits depend on other things other than the promise of the employer. There's no guarantee made by the employer as to the benefits which will be paid. The plan doesn't specify any benefits that the employees will receive or the method used to determine the benefits. They just get their share of the contribution that was made in their name. So the cost of the plan is known with certainty, and that's one of the reasons why defined contribution plans are becoming more common, because then cost certainty allows managers to plan for them. Of course, it means that they're riskier for the employee, so they're not quite as efficient in providing motivation or incentives for the employers. The accounting is relatively straightforward, and so the liability only shows up if the contributions haven't been made in full. So they have promised to make them. They have a liability to make the payment into the pension fund. There's an asset reported if the amount contributed is more than what's actually required for the period. So if they've over-contributed, then that reduces the amount of the future contribution. The benefit cost, or the benefit cost, which is the pension expense, is the amount that the company is required to contribute to the plan by the terms of the plan. And so if they've accrued contributions required to be made in future periods, provided for employee services provided in the current or prior periods, interest should be recognized on the accrued contributions. So if they have a situation where they're paying for expenses related to other periods, you would use discounting techniques to calculate the value of those contributions in this period. Defined benefit pension plans. These are much trickier to account for. So, what is a defined benefit pension plan? A defined easy for me to say. A defined benefit plan defines the benefits that the employee will receive at the time of retirement. So, the employer is actually promising a certain pension outcome. So they're responsible for the outcome as opposed to just the input. The formula that's typically used provides for the benefits to be a function of the level of compensation near retirement, usually something like the best 5 years of employment or the last 5 years of employment salary. So it's a function of the level of compensation near retirement and the number of years of service. The accounting for the defined benefit pension plan can be quite complex because the benefits are defined in terms of uncertain future variables. So an appropriate funding pattern must be established to ensure that enough money will be available at retirement to meet the benefits promised, because the problems associated with the pension plans involve complicated actuarial consideration. Actuaries are engaged to ensure that the plan is appropriate, and they make all of the appropriate calculations. So they have to make predictions about mortality rates, retirement, early retirement, all those sorts of things. So it can be quite a complex set of calculations. And the accounting for the defined benefit pension plans uses that information as the primary source of data for the accounting entries. So pension benefits are based on a formula. The trust's main goal is to ensure there will be enough pension assets to pay the employer's obligation as stated in terms of the defined benefits. The employer assumes the economic risk, because the employer has promised to make certain size benefits available to their employees, not just the contribution. So they're not finished when they pay cash. If the fund is not actually earning enough to make those benefits, they have to add extra. So they're not really sure at the time they make the contribution that it will be adequate. It's based on the best estimate prepared by their actuarial staff. So the employer is responsible for making the defined benefit payments no matter what happens actually to the assets in the trust. So the cost of the plan isn't known with certainty because it depends on all of these uncertain future variables. So the employer's obligation is a key part of the determination of the value of a defined benefit pension plan. So defined benefit plans can be vested or non-vesting, vesting or non-vesting. Vested or vesting pension plans provide a determination or a definition of when the benefit is owed to the employee. So the vested amounts in the plan become the legal property of the employee. In King's pension plan, there is no delay in vesting. There's no minimum service requirement for vesting. So as soon as we make pension plan contributions in our name, which are matched by the employer, then they belong to us. So they actually have to be paid out to us in the future based on the terms of the pension plan. Employees are entitled to receive those vested benefits even after leaving the employ of the corporation. So if we no longer continue working for King's, we would get the accrued benefits that are promised as a result of the contributions we made. We wouldn't have any additional an increase in the benefit, but we would get the benefits we were promised because they're vested legally our property. Accounting for defined benefit plans is not easy because the pension expense is not the same as the cash funding contribution, and so we use actuarial assumptions to come up with the key results. So the accounting. Most accountants agree that an employer's pension obligation is a deferred compensation obligation which it has to its employees for their service under the terms of the pension plan. And there are alternative ways to measure this liability. One approach is to base the obligation on the vested benefits, which current employees are actually entitled to. So that's kind of the minimum obligation that we might record. The vested benefits pension obligation is computed using current salary levels and includes only the vested benefits, which we call the vested benefit method. Vested benefits are those which the employee is actually legally entitled to, whether or not the employee remains in the service of the entity. So that's one approach. The second approach, or a second approach to the measurement of the pension obligation, is to base the computation on all the years of service performed by the employees under the plan for both vested and non-vested, using current salary levels. And this measurement of the pension obligation is called the accumulated benefit method, or the projected unit credit method. Third technique is based on both vested and non-vested service using future salary levels, which is the projected benefit method. And because future salaries are expected to be higher than current salaries in most cases, this approach results in the largest measure, or the most conservative measure, of the pension obligation. FASB, the Financial Accounting Standards Board in the States, the International Accounting Standards Board, and the Accounting Standards Board for ASPE have all adopted the projected benefit method as being the best measure for accounting purposes. So then we need to talk about the components of the defined benefit pension plan with the projected benefit method. And so it's considered to be the best measure. We need to calculate a number of things, including the defined benefit obligation. So the present value of vested and non-vested benefits earned as at the reporting date using future salary levels is the DBO, or the defined benefit obligation. ASPE also allows the defined benefit obligation for funding purposes, which is based on different variables, often uses a different discount rate. So the DBO for accounting purposes, defined benefit obligation, is the present value of vested and non-vested benefits using future salary levels. So companies recognize on their statement of financial position the full overfunded or underfunded status of their defined benefit pension plan. So the overfunded or underfunded status is measured as the difference between the fair value of the plan assets and the defined benefit obligation. So there may be an underfunding or maybe overfunding, and that actually results in an obligation, a liability. Whereas in the defined contribution plan, it was only whether they'd failed to make the contribution this period, that would create a liability, or if they'd over-contributed, so they've contributed more this period than they were required to by the terms of the plan, that would be an asset. But other than that, there's no additional liability. In this case, though, we're promising a certain amount of benefit to our employees after they retire. So that obligation is either fully funded or underfunded. It can be overfunded. There's been some cases in the past where overfunded pension assets have been clawed back by the company. And of course, that's very controversial because the employees see it as their money and the employers see it as their money. If they've got enough assets in the fund to fulfill the pension benefits, then they sometimes can take any excess back. Of course, they're also obligated to make up any shortfall. So in that sense, they're taking the risk of the defined benefit pension plan. Okay, so we'll talk a little bit more about the difference between IFRS and ASPE as we move along. So the defined benefit obligation. What happens to a defined benefit obligation? What is it that increases or decreases the DBO? The defined benefit obligation is not actually recognized in the company's financial statements, but it is the focus of accounting for pension costs, because the DBO is increased by the service cost, which is the cost of benefits to be provided in the future to employees in exchange for services in this current period. So matching says that we should record those costs because we're paying them to employees in exchange for what they're doing now in the period in which we're earning revenue. They're increased by any interest cost associated with the discounted DBO. So interest expense would increase it. So the cost of the interest cost associated with the discounted value. So if we're talking about making provisions for future contributions, then that obligation, we would calculate the effective interest, and the interest cost would be added to the defined benefit obligation. We would decrease it by any benefits that we actually paid, because of course that's a payment of our obligation, and so the benefits need to be removed from the obligation, and then it will be either increased or decreased by past service costs that arise when the plan is started or amended. So under recent changes in IFRS and ASPE, past service cost is included in pension benefit cost in the income statement. rather than being deferred and amortized. So you would adjust it 100% in the income statement this period for both IFRS and ASPE. So essentially what you're doing there is you're giving them retroactively a benefit based on what they've done in the past for us. It can also be increased or decreased by actuarial gains and losses arising from changes in the actuarial assumptions or from experience gains and losses. So if the actuaries expected them to earn a 10% return and they only earned an 8% return, that would be an experience gain or loss. So the difference between what the actuarial assumptions projected might happen or would happen and what actually did happen. Of course, they're not perfect at predicting the future outcome. So as a result, we have to adjust from time to time if they're not absolutely 100% correct. So the interest cost above is calculated using the current market rate under IFRS and either the current market rate or a current settlement rate under ASPE. Changes in the plan assets can happen. So the benefit plan assets are another major focus. So the defined benefit obligation is one major focus for accounting for pension costs. Another is what is included in benefit plan assets, and so that would include the assets set aside in a trust or other legal entity that's separate from the employer company, and they're restricted and can only be used to settle the related defined benefit obligations, not any claims of other company creditors. So they're already outside the corporate veil of the employer. Pension plan assets are increased by employer contributions in the period, and employees if they contribute as well. They're decreased by benefits paid to the retirees, and they're increased or decreased by the actual return on the planned assets. The measures of the defined benefit obligation, DBO, and plan assets are fundamental to pension accounting since they determine the plan surplus or deficit between the two of them. So accounting standards specify that they should be measured as of the date of the annual financial statements, so the balance sheet date or the statement of financial position date. Under IFRS, both the plan assets and the DBO are required to represent reporting date values. So December 31st year end, December 31st values. The difference between the DBO and the pension assets fair value at the point in time, at a particular point in time, is known as the plan's surplus or deficit. A plan with more liabilities than assets is underfunded, has a deficit. A plan with accumulated assets that are greater than the related obligation is overfunded and is said to have a surplus. Current service cost is the cost of benefits that will be provided in the future in exchange for current services, and those costs are prorated on the basis of the service. So the annual expense is based on the total estimated benefit being allocated evenly over the years of service of the employee. So current service cost is the benefits provided in exchange for the current period service. So the current service cost is part of the total determination of pension costs, and the most common components that make up the entire pension benefit cost would be current service cost, interest cost, actual return on plan assets, past service cost, and actual gains and losses. So there are 5 categories that affect the pension expense. The interest cost. Interest accrues on the defined benefit obligation as time passes, so similar to any other discounted debt. And so if it's a future payment, you would discount it based on an appropriate rate, which is for IFRS the current market rate. So it's referenced against current yield on high quality debt instruments such as corporate bonds or treasury bills, government bonds. Under ASPE, they're allowed to use what we call a settlement rate, which is an implied rate on the insurance contract that would effectively settle the pension obligations. So if they get a quote for an insurance contract that will promise to settle their pension obligation, they can use that rate as the rate to discount the future payments. The benefits actually paid to the retirees, of course, like any other liability, if you're actually paying off the liability, it decreases the amount of the liability. So the benefits paid to retirees would reduce the defined benefit obligation. Past service costs, in a way that's similar to defined contribution plans. When we start a new plan or amend a plan, it's possible that credit could be given for past years of service for the employees. So that amount would be included in the pension benefit costs in the income statement of the year that it is incurred, because it's an obligation to those current employees. Companies can also amend plans to reduce the benefits received, in which case there's a decreased DBO and a past service benefit to the company as opposed to a past service cost. Actuarial gains and losses. These are gains and losses which occur because of changes in actuarial assumptions, such as assumptions about future events, mortality, early retirement, inflation, all sorts of investment return predictions, those sorts of things. Experience gains and losses, I guess that would focus on the actual outcomes of investments in the plan. So any difference between their expected performance of the investments and the actual performance of the investments would be recorded as experience gains or losses, and would affect essentially the value of the assets in the pension fund. So actual gains and losses are the difference between what actually happened and the actual assumption that was made in advance of the event, which resolved the uncertainty. So all of these are part of the cost of the pension expense and benefit, and under IFRS, some of this cost is reflected in net income and some in other comprehensive income. Under ASPE, the entire pension benefit cost is all reflected in net income. There's no other comprehensive income component. Now, there is a new ASPE standard as set out in section 3462 of the CPA handbook, eliminated the deferral and amortization approach and no longer refers to the immediate recognition approach, which is now used. It no longer refers, in the past they had a deferral and amortization approach, so the new amount of pension expense, especially for past service, could be amortized in over a period of time. The new standard no longer refers to the immediate recognition approach, since it's now used for all plans, so they need to immediately recognize any change in pension benefits. They don't get to defer it any longer. Plan asset values, you start with the fair value at the beginning, you add any contributions made by the employer, add or subtract the actual return on those pension benefits, subtract any benefits paid to the retirees. That gives you the plan assets at the end of the period, and of course we need to reconcile all of those, and we'll do that in a worksheet in a bit. Contributions. Contributions to the pension plan are made each year by the employer and the employees, if it's applicable, if that's a matching situation. And federal and provincial law dictate the funding requirements according to the specified pension contract. Now, CRA also dictates regulations as to what contributions are tax deductible. Essentially, for CRA, most things are reflective of the amount of cash paid. So accrued expenses would not be deductible, but the cash actually paid into the plan would be tax deductible. Return on plan assets. Return on plan assets represents the income generated on the assets, less any administrative costs. And because of the fact that there's volatility in investments, a long-term rate of return would be estimated, and that expected return would be compared to what it was actually earned, and the value on the underfunded or overfunded status of the plan would be redetermined based on that actual return. So under both IFRS and ASPE, the rate used for the expected return must be the same as the discount rate used to calculate the interest cost. Under IFRS, the actual return on planned assets is allocated between the pension expense on the statement of comprehensive income and other comprehensive income. So specifically, the net interest on the net defined benefit liability or asset is recognized in net income, according to IAS International Accounting Standard 19.57. A remeasurement relating to the return on planned assets other than net interest on the net defined benefit liability or asset is recognized in other comprehensive income. In contrast, the remeasurements under ASPE are included in net income, including any remeasurement representing the difference between the actual return on planned assets and the return calculated using the discount rate used to determine the finance cost as discussed above. So in CPA Handbook, section 3862.085. Past service costs, curtailments, and settlements are a result of plan amendments, as we've talked about. So plan amendments instantly change the amount of the employer's obligation, so the total cost or benefit of the amendment is recognized immediately in pension expense under both IFRS and ASPE. Gains and losses relating to curtailments can result in a defined benefit or a past service benefit. Which International Accounting Standards 19.8 defines as a significant reduction by the entity in the number of employees covered by the plan. So that's the idea of a curtailment. Gains and losses relating to curtailments, a significant reduction by the entity in the number of employees covered by the plan, or any settlements, a transaction that substantially discharges or settles all or part of a DBO, are included in net income. Actuarial gains and losses result from items such as changes in actuarial assumptions and experience adjustments. To the extent that they're recognized as a component of pension expense in the same period they're incurred, the reported expense will tend to fluctuate significantly from year to year. So as you might expect, ASPE makes no adjustment for this. Instead, ASPE recognizes the full amount of the actual gain or loss in pension expense each period. IFRS is similar in that the gains and losses are not deferred, but under IFRS, the actuarial gains and losses are included in other comprehensive income rather than in net income. So experience gains and losses are adjusted to net income. Other adjustments because of actuarial calculations are included in other comprehensive income. So other components of expense identified in IFRS and ASPE include a part of the change in the valuation allowance related to the net defined benefit asset, if there is any. And so the limit on the carrying amount of a net defined benefit asset on the statement of financial position due to the asset ceiling test is explained in the chapter of the textbook. So now we're looking at developing a worksheet to illustrate how the transactions affecting the DBO and fund assets are committed in the accounts, and we're headed there shortly. So surplus to deficit, the defined benefit obligation at the end of the period minus the fair value of the plan assets gives you the plan surplus or deficit at the end of the period. If the DBO is greater than the plan assets, they owe more than they have in the plan. That's an underfunded situation or a deficit situation. If the DBO is less, that means they have overfunded or they have a surplus position. Pension cost needs to be accrued and recognized in accounting periods because it benefits from the employee's service this period. So matching says you're getting the benefit this period. You need to match it with the expense. The deferral and amortization approach, which was acceptable in the past, has been eliminated both with respect to past service costs or benefits. So costs are benefits, costs for increases in obligation to the employee's benefits from a decrease in the promised coverage, and any actual gains and losses would need to be recorded in income in the current period. So all components of the defined benefit costs are to be recognized in income. Under IFRS, gains and losses from actuarial changes in actuarial assumptions from remeasurements are included in other comprehensive income. So the statement of financial position, what you actually show on the statement of financial position, well, neither the defined benefit obligation nor the fund assets are recognized in the sponsoring company's accounts. They're both off-balance sheet accounts or memo accounts. The worksheet that we use will calculate pension expense, and that pension expense is made up of the following things: current service cost, which is a cost related to the employee's work in the current period. The net interest on the net defined benefit liability or asset, so that they're either if they're in a liability position, net interest, of course, is interest expense. In an asset position, interest is an interest income amount. Gains and losses from remeasurements, actual changes in actuarial assumptions. Under IFRS, this is put into other comprehensive income. Well, let's step back. Gains and losses from remeasurements related to return on plan assets. The actual amount of the change in the assets is recorded as net income, so the interest amounts, and any other remeasurements or changes in actuarial assumptions would be remeasured and put into other comprehensive income. Under ASPE, everything's included in income and disclosed separately. Any past service costs would increase pension expense. Actuarial gains and losses under IFRS are included in other comprehensive income. Under ASPE, they're in income as remeasurement and are disclosed separately from the other changes in pension expense. So we can develop a pension worksheet to show all of this. So we use this to kind of keep track of the DBO and the plan asset balances and their implications for the expense of the firm. So the logic. Neither the defined benefit obligation nor the fund assets are recognized directly in the sponsored company's account because they're both off-balance sheet accounts or memo accounts. The fund assets actually belong to the benefit trust, not to the sponsoring company. And the DBO is the liability of the sponsoring company only to the extent that there are not enough assets in the fund to cover the obligation. So the DBO is the excess, or that's the overfunded or underfunded amount. The sponsoring company only has an obligation if they haven't funded the fund adequately. So when applying the accounting approach under ASPE, the defined benefit obligation is based on either an actuarial valuation used for funding purposes or a separate actual evaluation prepared for accounting purposes. So it can take either one of these as its main objective. For funding purposes, we basically ask the actuary how much we need to contribute to the fund to continue to fulfill our promises. Or we can ask them directly to make the calculations for the accounting measurements. An actuarial valuation prepared for funding purposes is one that's prepared in accordance with pension regulations and legislation. It doesn't necessarily use the management's best estimates or the discount note required under an actuarial valuation prepared for accounting purposes. To simplify matters, in the examples that we use, we'll assume that the DBO is based on the actuarial valuation used for funding purposes. Under ASPE, we'll assume that that is actually equal to the DBO that would be calculated for accounting purposes under IFRS or ASPE. So it's kind of beyond the scope of this particular course to talk about that. So we can develop a pension worksheet to track pension expense and the net defined benefit liability or asset account on the statement of financial position, as well as the off-balance sheet amounts. And so it helps us to calculate the amount of the pension and the amount of the obligation. As its name suggests, the worksheet is a working tool. It's not part of a journal or part of a general ledger. It just it's a side calculation that allows us to make the journal entries in the correct amounts. So it merely accumulates the information needed to make the pension journal entries. The format of the worksheet that illustrates the relation among all the components under ASPE is shown below, and so that format of the worksheet will also apply under IFRS in situations where there are no remeasurement gains and losses. We'll add those in a couple of later slides. So let's begin with the first slide. So here, on January the 1st, 2016, we had no asset or liability position. So we had exactly equal. We had $100,000 of defined benefit obligation offset by plan assets of $100,000. So they offset to a value of 0. And then our service cost for the current service would have been debited to the annual pension expense, and it would increase the defined benefit obligation. No, sorry, it would decrease its liability. It would decrease. We'd credit the $9,000 to the defined benefit obligation, the liability, and then the net interest or finance cost would increase the planned assets and reduce the defined benefit obligation. So this wouldn't be accounted for in the company's books because it's in the pension plan. So the pension fund itself would recognize the increase in the plan assets and the decrease in the liability. And then if we made an additional contribution, that would reduce our cash. We would actually pay that out of the company into the pension fund. So the pension fund goes up, the plan assets go up by the $8,000 contribution, and cash goes down by $8,000 in this case. And then the fund pays out benefits to the beneficiaries. Of course, that doesn't affect the company's books at all because it's just affecting the pension fund's assets. Assets go down by $7,000, and the defined benefit obligation goes down by the same $7,000. So then we have our expense entry. The expense entry is to debit annual pension expense by $9,000 and credit the net defined benefit liability or asset, which is the company's net unpaid obligation. It's the difference between the defined benefit obligation and the plan assets, essentially. Cash, of course, reduces in the company when they pay the benefit, so that's the $8,000 difference. And so we have moved from a position where 100,000 matches 100,000 to the position where we have a $112,000 credit for the defined benefit obligation and a $111,000 debit for the planned assets, which is a net $1,000 credit. So we have a net obligation that we haven't paid yet into our pension plan. The journal entries would be to debit the pension expense and credit the net defined benefit liability or asset, and the cash payment would reduce the amount of cash we had and also reduce the net liability position. So the net impact of these two journal entries is that the net defined benefit liability or asset goes up by $1,000. So the net effect is that we essentially are underfunded by $1,000. And then in 2017, we start with the same opening position, 112,000 obligation and 111,000 of assets in the plan, which is shown on our balance sheet as a $1,000 credit into the net defined benefit liability or asset account. Past service cost now is added, so this is recognizing past performance of our employees, and so we're giving them a substantial benefit, which of course all needs to get into income this period. $80,000 debit to the expense and a credit to the obligation under the pension plan. The service cost is the current service cost, $9,500 increase in the pension expense, $9,500 increase in the obligation within the pension fund assets. Then we have the net interest or finance cost, So in this case, the plan assets went up by 11,100, and our deferred benefit obligation went up by 19,200, and so that could be as a result of a change in actuarial assumptions or something. So the net effect of those two entries is that our pension expense goes up by 8,100. And then we made a contribution of 20,000, so cash goes down and the plan assets go up by 20,000. Then we pay benefits, plan assets go down, obligation goes down. So the net effect of all of these things is the $97,600 debit to annual pension expense and a credit to the net defined benefit liability or asset amount. And then the contribution entry is $20,000 of cash paid out to reduce the net benefit or liability, the net defined benefit pension liability or asset account. So now the value is $78,600. We have an obligation of $78,600 and net benefit liability of $78,600, which is reflected in the pension plan as a $212,700 credit to reflect our obligation to our employees, matched against plan assets of only $134,100, which isn't adequate. We're in a significantly underfunded position. So our journal entries are debit pension expense for $97,600, and the liability goes up by $97,600. We record a contribution, which isn't as much as the amount of the expense. The contribution is $20,000, which reduces the net defined benefit liability by $20,000. But overall, this period, the liability position went up by $77,600. So under APSI, it's not really APSI, it's ASPE, but so there's a typo in the title here. In 2018, we started with a $78,600 credit position in our net defined benefit liability account, and that's made up of a $212,000 obligation matched against $134,000 of assets. So additional service cost this period increases the amount of the obligation. So that's recorded as an expense, increases the accrued benefit obligation within the fund account, within the pension fund. Net interest or finance cost increases the value of the plan assets, offset by a $21,000 increase in the accrued benefit obligation, resulting in a net increase in our pension expense of $66.60 this period. Remeasurement loss on plan assets would increase the pension expense and decrease the plan assets. So this is actual experience losses. That would reduce the value of the assets. Then we make a contribution this period of $24,000, which increases the assets, decreases our cash. We pay some benefits, $10,500, reducing assets and reducing obligation. Then we had actuarial loss due to changing the assumptions, so changing mortality rates or early pension retirement or early retirement predictions or other relevant. Inflation is a big one. Inflation predictions has an impact on profitability and impact on interest rates, and so would affect the amount of the obligation. So for whatever reason, the actuaries tell us we have an additional obligation to pay our promised benefits of $28,530 within the pension pension fund. That results in an increase in our annual pension expense of $28,530. So our total pension expense is $50,800. Our total contribution is $24,000. Those are the things that made it into our journal entry under APSI, Accounting Standards for Private Enterprises. Debit pension expense, credit the liability, and then debit the liability and credit cash for the amount of the contribution. So that's the accounting under Under ASPE, both the experience losses, the remeasurement losses, and the actuarial losses are both considered part of net income. For the IFRS pension worksheet in 2018, the remeasurement loss is recorded as an income impact, so it actually gets put into, where am I going with this? The transactions are the same. The remeasurement gain or loss goes into other comprehensive income, so 2610, the remeasurement loss on the plan assets, and the actuarial loss go into other comprehensive income. The service cost this period and the net interest or finance cost, the increase in the plan assets as they earn according to the actuarial assumptions. The plan assets increased by 14,610. The obligation went up by 21,270, and so the net impact was an increase in our expense of 6660. Then both the remeasurement and the actuarial loss were recorded as other comprehensive income, as a other comprehensive reduction in other comprehensive income. The contribution of 24,000 reduces cash, reduces plan assets. So, from the perspective of IFRS, we would include pension expense for 19,660, which is the service cost and the net interest or finance cost, and the remeasurement loss in other comprehensive income, including both the remeasurement loss on the plan assets and the actuarial loss of changes in assumptions by the actuaries. So that's the first entry to record the pension expense. It's split between other comprehensive income and the income statement effect of expense. And then the contribution, of course, is the same as it was under ASPE. So what we've seen is that in the worksheet, the left-hand columns of the worksheet under General Journal Entries. Let's go back one here. Under General Journal Entries, they determine the entries to be recorded in the formal general ledger accounts. The right-hand memo record maintain balances on the defined benefit obligation and the plan assets based on the amounts provided by the actuary and the pension plan trustee. And on the first line of the worksheet, the beginning balances are recorded, then subsequent transactions and events that relate to the pension plan are entered using debits and credits and using both the left-hand columns and the right-hand columns together for recording the entries. For each transaction or event, the debits must equal the credits, and the balance in the net defined benefit liability asset account must be equal to the net balance in the memo record columns. So if the DBO is greater than the plan assets, the pension liability is reported in the statement of financial position. If the DBO is less than the plan assets, a pension asset results. And that's about it for pension plans. So now we're looking at other post-employment long-term employee benefit plans with benefits that vest or accumulate. So other defined benefit plans with benefits that vest or accumulate. In addition to pension plans, companies provide their employees with other post-employment benefits as part of their pension or the compensation package. Those could include a lot of stuff, such as healthcare benefits, prescription drugs, life insurance, long-term disability, dental, eye care, legal and tax services, tuition assistance, free or subsidized travel. And in the past, most companies accounted for the cost of these other post-employment benefits, OPEB, other post-employment benefits, as an expense in the period when the benefits are provided to the retirees or their spouses, dependents, beneficiaries. So it's essentially a pay-as-you-go basis. That was in the past. In 2000, the Canadian standard changed to require companies to account for all defined benefit plans where the benefits vest or accumulated on the same basis as they account for defined benefit pension plans. So now these other defined benefit plans are treated the same way as defined benefit pension plans. Most common types of such plans are post-retirement plans to provide healthcare benefits. Accounting for these plans is identical to the standards of accounting for pensions. So accrual accounting is appropriate for post-retirement benefits, post-employment benefits, long-term compensated absences, so things like sabbatical. which is provided to faculty here at King's. So all of those would use the same techniques as we've just discussed for pension benefits. The right to the benefit is earned by rendering the service, so the cost and the related liability are accrued as the employee provides service. IFRS generally follows the same approach as for pension plans, except, of course, that actuarial gains and losses and past service costs are reflected in other comprehensive income. Under ASPE, defined benefit plans where benefits vest or accumulate based on service are accounted for in the same way as defined benefit pension plans. There are some differences between pension plans and post-retirement healthcare benefits. For example, funding. Pensions are generally funded, whereas healthcare benefits are generally not funded. They're paid as they're required. The benefit for pensions are well defined. There's a level dollar amount, so it's usually well understood in advance. Healthcare benefits are, of course, determined by the healthcare needs of the retired workers. So generally, it's uncapped. There's a great amount of variability in healthcare benefits. The beneficiary for the pensions is a retiree. The healthcare benefits would include retiree, spouse, other dependents. It could include a list of several people, whereas pension is just referring to the retiree, or maybe a benefit for the surviving spouse in the case where the retiree passes away. The benefit payments, pensions paid on a regular basis as income. Healthcare benefits are paid as needed and used. Predictability, pension benefits are variables. The variables in pension benefits are reasonably predictable, include things like mortality and early retirement, inflation, those sorts of things. Whereas for healthcare benefits, it's difficult to predict, so it varies geographically. So in the U.S. medical plans are quite different than the Canadian plans because of things like Medicare, but healthcare benefits do fluctuate over time. Defined benefit plans with benefits that do not vest or accumulate, so things like parental leave plans in excess of what the government provides, and any long-term disability plans would be included here. So both ASPE and IFRS make no attempt to accrue the benefit costs and liabilities related to employee benefits that do not accumulate with the additional service. In this case, there's no basis on which to assign the cost to periods other than the period in which the benefits are taken. So a good example is costs associated with parental leave or unused sick pay that do not change with an employee's length of service. Instead, both the total cost and liability are recognized when the event occurs that obligates the company to provide the benefits. So this is referred to as an event accrual method of accounting for benefits and was explained in Chapter 13. So the event accrual method accrues the full cost, and when the event occurs that obligates the entity, we record the benefit expense and record the benefit liability. If there's a compensated absence which is taken, the benefit liability is paid and cash is reduced, which you may remember from Chapter 13. Moving on to presentation issues. IFRS and ASPE on the income statement identify the components that make up the benefit cost for the period, and both indicate that a portion of these costs may be required to be treated as a product cost in inventory or capitalized in property, plant, and equipment assets, because part of the benefit of the employee's service may be included in those things. So if they're involved in producing our inventory, it would be treated as a product cost and capitalized there. If it's part of the construction of a property, plant, and equipment asset, then the cost would be included there as well. And neither IFRS nor ASPE dictates how the components of benefit costs are to be reported on the income statement. So companies have the option of reporting current service costs and net interest or finance costs in one of three ways, either as separate components or as part of similar expenses, so added into compensation expense, for example, or in total as a single benefit cost. So many companies choose the third option, reporting all of the components together as a single account labeled benefit costs. The defined benefit assets or liabilities are generally reported separately for each benefit plan, unless all the plan assets result in asset or liability. So if some are debits and some are credits, you wouldn't offset them. Generally classified as long-term assets because they refer to future benefits for the employees, which we're probably not going to be paid within the next year. Disclosure requirements. Given that pensions and other defined benefit plans are significant and specialized, it's not surprising they have extensive reporting and disclosure requirements. ASPE requires only a limited set of basic information in addition to the accounting policy choices the employer has made under IAS, International Accounting Standards 19 employee benefits. International accounting standards require a high level of accountability from companies for the effect of such plans on their current and future performance, financial position, and risk. Under ASPE, separate disclosures are required for plans that provide pension benefits and other types of employees' future benefits. Most of these disclosures are for defined benefit plans. The required disclosures include a description of each type of plan, any major changes in the terms of the plan during the year, the effective date of the most recent actuarial valuation for funding purposes, so they know how long it's been and how recent the reassessment was. The year-end surplus or deficit, including the fair value of the plan assets, and defined benefit obligation. So even though we don't account for those within the financial statements of the employer, both of them are important pieces of information for the analysis of the value of the firm. So if it's overfunded or underfunded, it makes a difference to the value of the business. And an explanation of any difference between the amount reported on the balance sheet and the planned surplus or deficit. And any additional information which is needed by users should be available from the company as well. Additional disclosure requirements under IFRS. The objective under IFRS is to provide disclosures for a broad range of users with no access to additional information. So the information should describe such things as the characteristics of the defined benefit plan, any risks associated with them, the amounts in the statements arising from the plans, how the defined benefit plan helps them assess the amounts, timing, and likelihood of the cash flows that are associated with future benefits. So how does it help them with cash flow management? In addition to a description of each defined benefit plan or groupings of similar plans, and what accounting choices were made where choices are permitted, the following types of information are also required: reconciliation of the opening balance to the closing balances of the present value of the net defined benefit liability or asset, the plan assets, and the present value of the DBO. The amounts included in periodic net income, so the amount included in expense such as current service cost, interest expense, return on plan assets, along with amounts recognized under comprehensive income such as actuarial gains and losses from changes in assumptions. Any sensitivity information for significant actuarial assumptions, including the impact on the DBO and the changes from the previous period in methods and assumptions used in the sensitivity analysis. Many other disclosures, including details relating to classes of items making up the fair value of plan assets, asset liability matching strategies, sort of hedging arrangements by management, any funding arrangements that affect future contributions would have to be disclosed as well. Analysis generally focuses on predicting future cash flow obligations, so how much the company will actually have to pay into the pension fund. So it's important to validate the major assumptions, so whether or not the actuarial assumptions are reasonable in the circumstances. And so it's important to validate the major assumptions underlying the fund status and any future cash requirements, especially the discount rate used to measure the defined benefit obligation, and any current service cost, any interest cost. Small changes in key variables can have a very significant impact. So for example, assumptions about return returns on investment can make a big difference in terms of the obligation the company has in the future. There is an appendix for the chapter dealing with an example of a one-person plan, and so you can take a look at the example in the text if you're interested in that. Looking ahead, both ASPE and IFRS agree on the objective to recognize a liability and a cost in the reporting period in which the employee has provided the service. So matching pretty clearly says that if you're doing the work this period, any benefits that arise as a result of the work that you do this period should be recorded in this year's expenses. And so there's only minor differences in how these are applied under ASPE and IFRS. And that is it for the chapter.